Nice to see you again in 2021, and Happy New Year. I think I can still say that. It's never a dull moment in markets, and certainly we've already kicked off this year with political fireworks. That said, the markets have looked beyond this. Equity markets are already up. Bond yields are going up as well. Bitcoin is certainly a sign of the exuberance we're seeing in the environment. One thing we're seeing is beginning of the year investing changes. It's always interesting beginning of the year when you see theme changes in areas where you start to establish a new consensus. What this often means is valuations can become stretched in certain areas. For us as fundamental investors, this realizes opportunities where we are navigating by individual outcomes, looking at companies rather than using a sextant and navigating by the stars. We're very much looking at the outcome that may be due to individual company changes, selection, and this is where we're going to find our opportunities in 2021. Some of these themes that we are looking at is the value versus growth. Growth as an equity style outperformed value by the largest ever margin on record in 2020, 34%. This started to actually change in the final quarter of the year, and we've seen that change more this year. We do think that value can outperform growth in 2021. One of the big drivers of this has been interest rate changes. I think generally the underappreciated area that is driving growth is not simply that these companies are realizing the possibility of higher revenues in the future. It's simply that those cash flows in the future in a low interest rate environment are being discounted at a lower rate. They're becoming more valuable just mechanistically by lower interest rate policy. As I speak to you now, President-elect Biden is preparing to open the details on his upcoming stimulus plan. By all indications, look to be a $2 trillion proposal with more fiscal stimulus, with monetary policy remaining low. What we can see is intermediate interest rates rising. Nominal growth expectations may be rising. Inflation expectations may be rising. What that does is that decreases the value of those long-term cash flows. It increases the value of value versus growth. We think that could be a big dynamic this year. The consensus is that higher taxes are coming in the first couple of months of this new administration. I think one thing that we might look at is we're still in the midst of depressed economic activity. There are a lot of policies, a lot of priorities that the new administration wants to get through, which include things like fiscal stimulus, healthcare. I think we may actually see a deprioritization of things like higher taxes. Moving the tax rate from 21 to 28% for corporates was one thing proposed. Increasing the tax rate on high net worth individuals was one thing proposed, high earners. We may see that push back maybe even into past the midterm. There's a razor thin margin in Congress that is for the Democrats right now after the Georgia election. I think the Democrats may want to actually keep that margin and be able to get their policy through for the full 4 years, not just 2 years. So we may see that pushback. That will give a lift to markets as fiscal stimulus is positive for markets, taxes are negative. Pushing back taxes will actually create a little bit more lift to markets in the near term. One thing I expect to see as a theme this year as well is higher mergers activity. Cheap capital, high corporate cash balances, heightened growth expectations. All those things are a recipe for companies that want to look forth for business combinations. They want to take advantage of higher margins and capture synergies where they can and use cheap capital to appreciate at a better rate to provide a good shareholder return. Now, what that means is opportunities for fundamental investors as we look for good realization or bad realization of synergies from these business combinations, or look for takeout targets where you might actually see a premium paid for a company that we own. We've spoken a lot about the impact that COVID has on businesses, and you've seen a lot about this. I think one underappreciated thing is businesses did not just sit still. They navigate or they die. So businesses are innovating. One thing we know is necessity is the mother of invention. And so we're actually going to see some of the businesses that are able to navigate the environment, have produced new revenue streams, have gone ahead and innovated, vis-a-vis their online distribution or the kind of products that they offer in a new environment. That's going to create opportunities, number one. Number two is we saw a lot of cost cutting because of the expectation that this would go on for considerably longer. Certainly the unemployment rate is still elevated because many companies have not brought their full workforce back. That could actually lead to higher margins in the near term. That's a positive dynamic for the overall equity environment. Given these themes and our outlook, we are broadly positive. The 2021 economic outlook, we're looking for at least 5% on real GDP growth coming into 2021. This is going to create extraordinarily strong opportunities for fundamental investors in terms of looking for business combination opportunities, looking for those that are appreciating new revenue streams, that have innovated well, that have higher margins. So we're excited about the environment that we're in. We think it's going to really benefit those who are appreciating selection. We'd be very happy to discuss any of our ideas with you. Thank you for your time, and we look forward to seeing you soon.